Good afternoon. Time to check in on the markets now. Asian markets had a bit of a mixed performance, and that is as investors look ahead to the U.S. inflation data. The rand was flat on the day. Of course, SPA did release their trading update. A little bit slower, especially when we saw from the sales point of view, single-digit sales, and a lot of it, the South African operations reflecting much of what we're seeing when it comes to the energy crisis. We also had Telkom releasing an update, and we'll unpack some of the key components coming out of that with our market watcher. But I hinted that we are expecting that US CPI inflation data to come through a little bit later on. It's expected to come in at 6.2% in January. And if that is correct, this would be the lowest since October of 2021. And it's likely to lift markets in the hope that the Fed might change tact. Consumer prices gained 6.5% in December, and that was down from June's 9.1% annual rate, which was the highest since 1981. So there's a good reason to think that inflation will keep falling, and even so, inflation is still above the Fed's 2% target rate. And this even if you exclude the volatile food, energy categories, core inflation coming in at 5.7% in December. So the main question we're all asking is that how do we expect it to fall all the way back down to 2%? Markets seem to believe that this is going to happen all on its own, but the Fed Chair Jerome Powell completely disagreeing, and we're going to go into some analysis to talk about what that hinges on. A lot of what we see in today's CPI data hinges on three things which I'll be paying attention to. That's goods, shelter, as well as other services, and that is because they react quite differently to how inflation is put together, as well as some of the macroeconomic aspects. But let's look at that inflation gauge, and this is what I've been tracking since 2020, and a lot of it came in from what we were seeing, especially when it comes to goods inflation. There were surging prices coming in from manufacturing, as well as the autos, that's cars and furniture, that contributed a large share to that high spike in inflation that we saw in 2021, coupled with a lot of the supply bottlenecks, but those supply bottlenecks have seemed to have eased, and demand is now shifting from what we saw on the goods side more to services. Another thing that investors are going to be paying attention to, and we'll stay on this chart just so I can emphasize the importance of it, is rent deflation, and that is because we saw demand from housing, apartments, as well as that work from home pushing up prices. It was the rent housing that contributed about 0.5% of what we saw in that December 5.7% inflation data. Economists are expecting the prices coming through reflecting on the apartments and housing to come down slightly, well, to initially rise but come down from June. What I will be paying attention to in particular, especially when that figure comes out, is what we call core services, and this is a reflection of this graph that we're seeing here, US inflation and wage growth. Now, core services, this excludes your food, energy, goods, as well as shelter. Some economists also call it super core. It's been running at around 4%, and wages contribute a large part to what we're seeing in the rise of this particular cost increase. And a lot of it has to do with the shortage of workers. Fed Chair Jerome Powell did indicate that there's still quite a lot of work to be done on the inflation front in order for them to believe that wage growth is showing signs of decelerating. And it is showing signs of decelerating, but the levels are still quite high. But to talk to us about what we can expect, the market dynamics, as we look ahead to that inflation number, we are joined by Martin Smith, who is from Anchor Capital. Martin, thank you so much for your time. I mean, I gave a little bit of what I'm going to be paying attention to where that inflation print comes out. But from your screens, what's the market sentiment ahead of this all-important January CPI figure?
I think the market is literally just waiting with bated breath. I mean, it's such a binary outcome. I mean, if it comes in at expectations or slightly better, you'll see the market rally, and it's looking for about 6.2. I think you mentioned that earlier. From a headline perspective, if it misses that, I think you'll see the market sell off relatively aggressively. So I think everyone is just sitting, waiting. There's no conviction either which way, and everyone's waiting for 3:30 when it comes out South African time.
The one thing we were all talking about, at least in the newsroom, was where the rand was sitting at, breaching 18 to the dollar, but managing to come back down slightly. Some of the factors contributing to that, I mean, a lot of it has to do with the fact that we are looking forward to the CPI data, but some of the local risks that you're seeing that could possibly be contributing to this performance.
I think it'll be a little bit with regards to kind of what's happening with Eskom and from a state of emergency that we've had come through. But ultimately, it mostly comes down to international and global factors. So I think when you look at what the Fed officials said around CPI, I mean, around interest rate hikes, and that kind of continuing, and there being no cuts for the rest of the year, I think once that started to play into investors' mind, I think then you saw that really start to move on the rand. That's the main factor. Like I said, a little bit of what's happening from an Eskom perspective, but predominantly, I think, from global factors and a hawkish Fed.
Where do you sit on the soft landing debate, especially when you look at what's going on in the bond market, which seems to be convinced and listening to the Fed, versus what the equity market is doing, which is probably not believing anything that the Fed is saying? Where are you sitting on that debate?
No, you're right. I think the equity market is hoping for rate cuts by the end of the year, and potentially a Goldilocks scenario of inflation coming off without there being a recession. But I think we are very much in the camp, along with consensus, that you will see a soft landing of sorts. I think the kind of US economy will start to soften, and the jobs market will start to soften in the back end of this year. And you'll see some negative numbers coming from a GDP perspective. So that's where we're sitting at the moment. Like you said, I think the equity market is maybe a little bit more hopeful.
Telkom released their update as well, pushing to raise 1 billion rand from financial institutions. What do you make of it? And also your conviction on Telkom as a stock?
So I think it was a relatively decent update in a very tough operating environment for them. Some positive news is around the disposal of some assets, which should be positive for them, obviously. You also saw slightly better than expected numbers come through. You've also seen this share being very cheap at the moment, which is probably why the share is up 5.5% at the moment. What do I think about it going forward? Again, operates in a very tough environment. Yes, you might have some corporate action around MTN come through. I don't know. That's obviously something in the background, but it's not one that I'm entirely convinced of right now. But again, there is potential for optionality around the corporate action side of things. Speaking
of an environment, we have an environment of high inflation, high interest rates. The SA listed property sector, I mean, do you like this one? Do you see value in it with the environment that we're currently in, or is it one of those wait and see approach?
So I think if you look at property in South Africa, you've got two portions, right? You've got SA property that's exposed to offshore markets, SA property that's exposed to local markets. The offshore ones are doing very well because there's some growth there. You've obviously seen a weakening of the rand. Local ones are operating in a kind of low growth environment. So it's tough there. Although you're getting a good dividend yield, the growth isn't really coming through. So it depends on your view of, do I go offshore, there's a little bit of growth, and your view on the rand, or do I go local, you get a divi yield? I think in the kind of context of what you're getting in the bond market at the moment, not overly excited by what I'm seeing in the property sector at the moment.
All right. Well, let's leave it there, Martin. Thank you so much for your time. That is Martin Smith from Anchor Capital. And looking at the rand, 17.85, as we are looking forward to that all-important January US CPI figure. We'll unpack how the market reacted to it. We'll also touch base on some of those components that I said that I'm going to be paying attention to, looking at Super Core, which is quite important for me, but also how market has reacted post this number coming out. But we're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.